Welcome to the Sykes & Company PA video blog.
Three common mistakes we see with pharmacies that walk in the door is one, the accounting fundamentals are just not in place at all. Two is the inventory and the margin issues we typically see. And three would be the receivables and the payroll issues. Those are the three most common mistakes. And going back to number one, the accounting fundamentals are so vastly important because without that fundamental in place, you're not going to be able to do proactive tax planning. You're not going to be able to prepare accurate financial statements. You're not going to know what's going on in your pharmacy and what areas you need to work on and better manage your pharmacy with. So the fundamental piece is a common error we see. Pharmacies walk in the door and they say, I just don't know where I stand. I don't get my financial statements until 6 months later. I just got my 2017 tax return, et cetera, et cetera. So, not having that fundamental system is very common. I'd say it's about at least 7 out of 10 that we're seeing that don't have that fundamental in place. And what fundamental accounting looks like, your balance sheet is tied in. You're recording the daily processes in real time. The payables are tied in, payroll's tied in, and you're making those adjustments timely on a month-end basis. So you've got a real-time accounting system with integrity, fundamentals. You're able to do those financial statements, the advisory, and then the proactive tax plan, and you're able to plan ahead for tax mitigation. That's what a fundamental accounting system looks like, and we don't see that often. The next one we typically see is the margin issue and how that relates to inventory. A lot of times I see pharmacies that have margins in in the teens, total margins, including rebates in the teens. And once we get a feel for what kind of a product mix the pharmacy has, what they're doing behind the bench, what other revenue diversification they have in the pharmacy, we're able to glean a good understanding of if that margin's reasonable or not. And a lot of times it's not. A lot of times they're underperforming compared to their peers from what we typically see in-house. And they don't really have a clue why. So that's going to open the door for us to go in and start asking the questions on why their margins are lower than what they should be. And a lot of times that turns into inventory and the importance of inventory to the whole process. The tighter your inventory is, the better managed your inventory is. Of course, the more accurate your margins are going to be, the more accurate your bottom line net income is going to be, and you're just going to be able to have those numbers to ask the questions and to get a good sense of what's going on. And if the margins are really where they are and they're underperforming, it's going to allow us to ask those questions and say, what are you doing behind the bench, or how are you pricing, brand, generic, et cetera. So that's one of the most common mistakes. The third one is accounts receivable and payroll. Pharmacies, this is probably 8 out of 10 pharmacies, do not control, manage, or even know what their third-party reconciliation is or what their third-party monies due to the pharmacy are on a monthly basis. They just don't have a clue. They don't think it's important. And they don't really, it's just not a big deal. Well, it is a big deal. Third-party receivables are going to make sure your revenues are where they should be, accurately reported, which of course is going to tie into your margin, your net income. Third-party receivables are also going to give you a sense of what's owed to you. How of those payers that owe you money, how many are over 60 days? How many are over 90 days? Why are they over 90 or 60 days? These are questions you can gain from having the systems in place to manage and track this stuff. And a lot of times, if you spend some time and you manage the process, you're going to find some areas where instead of getting paid in 60 days, you can maybe make some adjustments on your end, on the pharmacy end, and get paid in 15 days. I have seen that happen. So knowing what's going on with third parties and taking that seriously is going to provide that a better piece of the fundamental accounting and give you that ability to manage what is owed to you and how long, et cetera. And then, of course, payroll is always a common mistake we see. With margins where they are in a community retail pharmacy in the 22 to 26 range, around in there somewhere. Payroll should be in the 10-11% of gross revenues. If it's in the single digits, you're outperforming. And the most successful pharmacies do have payroll in the single digits. Payroll in the single digits means total gross payroll, not including benefits and taxes. So payroll is a key area there. If it's over 12%, maybe 13, 14, 15%, yellow flag, red flag, you got to rein in that payroll and manage that, because that is eaten right into your cash flow, eaten into that balance sheet, the condition of your balance sheet, and eaten into your overall stress, because you're going to be feeling that each and every day as you attempt to pay your wholesalers and other bills. So managing that payroll is very important, and a lot of times that is just an easy, common mistake we see.
Thank you for watching. If you enjoyed the video, we invite you to subscribe to our YouTube channel.